I was having breakfast this morning at the same little diner I've been going to for 40 years, and the waitress asked me what keeps me up at night. I told her the truth, nothing keeps me up at night, I sleep just fine. But what occupies my thoughts during the day, well, that's a different story altogether. I've been watching something develop in these markets, something I've witnessed several times in my life, but never quite on this scale. There's a migration happening, a massive reshuffling of capital that's going to change the financial landscape for millions of people. And the peculiar thing about it is that most folks are going to miss it entirely, even though it's happening right in front of their eyes. I've lived through quite a few market episodes now. I saw the crash of 73 to 74 when stocks got absolutely pummeled. I watched the savings and loan crisis unfold. I sat through the technology mania at the turn of the century when companies with no earnings were worth billions. And of course, I'll never forget 2008 when the entire financial system nearly came apart at the seams. Every single time, without exception, wealth moved from one group of people to another, not because of some conspiracy or manipulation, but because of something far simpler. It moved because some people understood what was happening and others didn't. Some people kept their heads while others lost theirs. Some people saw opportunity where others saw only catastrophe. What I'm observing now is the setup for another one of these episodes, and I believe it's going to be larger than anything we've experienced in modern times. Now, before you think I'm predicting doom and gloom, let me be clear about something. I'm not saying the sky is falling. I'm not saying the economy is going to collapse. What I'm saying is that there's always a transfer happening in markets, but there are certain moments in history when that transfer accelerates, when it becomes dramatic, when fortunes are made and lost based entirely on how people respond to circumstances. Let me take you back to something that happened early in my career. I was in my 20s, and I had saved up a little money working various jobs, delivering newspapers, working at my grandfather's grocery store. I bought shares in a textile company called Berkshire Hathaway. Now, everyone thought I was crazy because textiles were a dying industry. The company was struggling, but I saw something. I saw that the stock was trading below the value of the working capital. Essentially, I was buying dollar bills for 40 cents. The business itself wasn't wonderful, but the price was so low that I had what my teacher Ben Graham called a margin of safety built in. That investment didn't work out the way I initially thought it would. The textile business eventually closed. But because I bought it cheap and because I later used the company as a vehicle to acquire better businesses, well, you know how that story ends. The lesson there wasn't about textiles or any particular industry. The lesson was about price versus value. Understanding that distinction is going to be crucial in the years ahead. See, value is what something is worth. Price is what you pay for it. They're often different, sometimes wildly different. When price and value align, you've got a fair deal. When price is below value, you've got an opportunity. When price is above value, you've got a problem waiting to happen. The wealth migration I'm talking about happens when large numbers of people forget this basic principle. They start confusing price momentum with value creation. They start thinking that because something went up yesterday, it will go up tomorrow. They start believing that the rules somehow don't apply anymore. I'm reminded of something that happened in our office not long after I started Berkshire. We had bought See's Candies, a chocolate company out in California. People thought we overpaid. We put down $25 million for it. But I looked at that business and I saw something beautiful. I saw a brand that people loved. I saw a product that people bought for special occasions, birthdays, holidays, moments that mattered. I saw pricing power, the ability to raise prices without losing customers. Most importantly, I saw that the business didn't require much capital to operate. Every year, it generated cash that we could redeploy elsewhere. That $25 million investment has generated over $2 billion for us over the years. We didn't do anything clever with it, we just owned it. We let it do what it does best, make chocolate that people love and generate cash flow. That's really the core of successful investing. Find businesses that create value over time, pay a reasonable price for them, and then do the hardest thing of all, which is nothing. Just let them work. Most people can't do this. They're hardwired to act, to do something, to react. They see the stock price move, and they feel they need to respond. They read some news, and they think they need to adjust. But all that activity, all that motion, it's usually counterproductive. The friction costs, the taxes, the bad timing decisions, they eat away at returns. Charlie Munger, who was my partner for 6 decades, used to say that the first rule of compounding is to never interrupt it unnecessarily. Think about what that means. If you've got something that's working, something that's generating returns year after year, the worst thing you can do is interfere with that process. Yet that's exactly what most investors do. They buy something, it goes up a little, they sell it to take profits, or it goes down a little, they sell it to cut losses. They're constantly interrupting the compounding process. They're like someone who plants an oak tree and then digs it up every few months to check on the roots. Now, let's talk about this migration more specifically. Where is the wealth going to flow from, and where is it going to flow to? It's going to flow from people who treat investing like gambling to people who treat it like business ownership. It's going to flow from people who need constant action to people who are comfortable with patience. It's going to flow from people who follow the crowd to people who think independently, and most significantly, it's going to flow from people who panic during market turbulence to people who see turbulence as opportunity. I want you to understand something about market downturns. They're not disasters to be avoided. They're opportunities to be embraced if you're prepared for them. During the financial crisis, we invested billions when everyone else was running scared. We put money into Goldman Sachs, into General Electric, into various other companies that were temporarily out of favor. People said I'd lost my mind. The headlines were apocalyptic. But I wasn't betting that the world would be fine. I was betting that if the world survived, which I thought was likely, these businesses would be worth far more than we were paying. That's the margin of safety principle in action. Even if I was somewhat wrong about the recovery, the prices were low enough that we'd still do okay. One of the biggest misconceptions people have is that successful investing requires you to be right all the time. That's nonsense. You just need to be right more often than you're wrong, and when you're right, make sure you've bet enough that it matters. When you're wrong, make sure your mistakes are small enough that you can recover from them. I've made plenty of mistakes. I held on to dying businesses too long. I paid too much for certain acquisitions. I passed on opportunities I should have taken, but my mistakes were relatively small and my successes were large enough to more than compensate. That's all you need. You don't need to be perfect. You just need to avoid doing anything catastrophically stupid. This brings me to temperament, which I think is more important than intelligence when it comes to investing. I've known plenty of people with high IQs who've done poorly with money, and I've known people of average intelligence who've done extremely well. The difference is almost always temperament. Can you remain calm when others are panicking? Can you resist the urge to join in when everyone around you is making easy money on some speculation? Can you think in decades rather than days? These are questions of temperament, not intellect. I grew up during the Depression. I saw what fear could do to people, how it could paralyze them, cause them to make terrible decisions. I also saw what greed could do during the various bubbles I've witnessed. Fear and greed, those are the two forces that drive most market behavior. If you can master those emotions in yourself, if you can be rational when others aren't, you've got an enormous advantage. That advantage is going to be crucial during this coming migration because the people who maintain their equilibrium are going to be the ones who prosper. Let me tell you about a concept that's been central to how I think about investing. It's something Ben Graham taught me when I was studying at Columbia. He called it Mr. Market. Imagine you're in business with a partner who's manic depressive. Some days he's euphoric and wants to buy you out at ridiculously high prices. Other days he's suicidal and will sell you his share for almost nothing. You're not obligated to trade with him. You can ignore him completely if you want. But occasionally, when his price is extremely attractive, you can take advantage of his mood swings. That's exactly how the stock market works. It's there to serve you, not to instruct you. Its job is to provide you with opportunities, not to tell you what to think. Most investors get this backwards. They look at market prices as information about what they should do. When prices are going up, they think that's a signal to buy more. When prices are falling, they think that's a signal to sell, but that's exactly wrong. Prices going up means things are getting more expensive, presumably less attractive to buy. Prices going down means things are getting cheaper, presumably more attractive. Yet human psychology leads us to do the opposite. We feel smart and safe buying what's already gone up. We feel scared buying what's going down. Understanding this psychological trap and avoiding it is going to be essential in the years ahead. Now, I want to talk about something that might surprise you. The best investment most people can make isn't in any stock or bond or piece of real estate. It's in themselves. Whatever you invest in developing your own abilities, your own knowledge, your own skills, that's going to pay the highest returns over your lifetime. Nobody can take that away from you. The market can't crash it. Inflation can't erode it. You carry it with you wherever you go. I spend 5 or 6 hours every day reading. Even now in my 90s, I read financial statements, annual reports, newspapers, books, anything I can learn from. People ask me what's changed over the decades. The answer is almost nothing in terms of fundamental principles, but I've gotten better at applying them because I've never stopped learning. If you want to position yourself for this wealth migration, the first step is to become what Charlie called a learning machine. You need to constantly expand what you know, not just about finance, but about business in general, about human behavior, about history. The patterns repeat themselves. If you study history, you'll recognize when similar patterns are developing. You'll see the warning signs of bubbles. You'll recognize when fear has created opportunity. Knowledge compounds just like money does. The more you learn, the faster you can learn new things because you have more mental frameworks to fit new information into. There's a mathematical concept that every investor needs to understand deeply, and that's compounding. Albert Einstein supposedly called it the most powerful force in the universe. I don't know if he actually said that, but it's certainly the most powerful force in investing. Compounding is what happens when your earnings generate their own earnings, which then generate more earnings. It starts slowly, almost imperceptibly, but over time it becomes powerful beyond what most people can imagine. The key is time and not interrupting the process. If you can compound money at even moderate rates for long enough periods, the results are extraordinary. I like to use the example of a penny doubling every day for a month. On day 1, you have a penny. On day 2, you have 2 cents. By day 10, you have $5.12. Not very impressive. But by day 20, you have over $5,000. By day 30, you have over $5 million. That's the power of compounding. It looks modest early on, but it becomes explosive over time. Most people underestimate it because they think linearly. They can't intuitively grasp exponential growth, but if you understand it, if you harness it, if you give it time to work, it can transform your financial life. The coming wealth migration is going to massively favor the people who understand compounding and give it time to work. It's going to punish the people who are constantly interrupting the process, constantly starting over, constantly trying to time things perfectly. You don't need perfect timing. You just need patience and the discipline not to do something stupid. Let me share something about mistakes because they're inevitable. I've made my share. I bought a shoe company called Dexter and lost several $1 billion I held U.S. Airways when I should have sold. I missed investing in some of the great technology companies because I didn't understand them well enough. Mistakes happen. The key is learning from them without becoming paralyzed by fear. What I've learned is that mistakes of omission, things I didn't do, are less costly than mistakes of commission, things I did wrong. If I pass on an investment and it does well, I've missed an opportunity. But if I make a bad investment, I lose capital. Given the choice, I'd rather miss opportunities than lose money. But the real key is to make your winners big enough that they overwhelm your mistakes. One of the advantages I've had over the years is a long time horizon. I've never thought in terms of quarters or even years. I think in terms of decades. When we buy a business, I'm not thinking about what it'll be worth next year. I'm thinking about what it'll be worth in 10 or 20 years. That long-term thinking allows you to ignore short-term noise. It allows you to focus on what really matters, which is the fundamental earning power of the business and how that's likely to develop over time. The wealth migration that's coming is going to reward long-term thinking like never before because short-term thinking has become so prevalent. Everyone wants instant results, instant gratification. But the real money, the lasting wealth that comes from patient capital, from thinking beyond the next quarter or the next year. Now let's talk about what you should actually be doing. How do you position yourself practically? First, you need to build a watch list of businesses you understand and would like to own. These should be companies with durable competitive advantages, what I call moats. They should have capable management teams who treat shareholders as partners. They should be generating good returns on capital. You should know these businesses well enough that you could explain them to a child. If you can't explain it simply, you probably don't understand it well enough to invest in it. Simplicity is a virtue in investing. Complexity is where mistakes hide. Second, you need to determine what these businesses are worth. This doesn't have to be precise. I'm not looking for 3 decimal places of accuracy, but you need a reasonable estimate of intrinsic value. Then, and this is crucial, you need to only buy when there's a significant discount to that value. That discount is your margin of safety. It protects you if your analysis is wrong or if unexpected things happen. Most people skip this step. They find a good business and buy it at any price. But price matters enormously. A wonderful business at a terrible price is a terrible investment. Third, you need to be patient. This is where most people fail. They can't stand to sit and wait. They feel like they need to be doing something. But investment success is largely about waiting for the right opportunity and then acting decisively when it appears. You can wait years for the right pitch. In baseball, you have to swing at strikes. In investing, you can watch pitches go by forever until you get one right in your sweet spot. Take advantage of that. Don't feel pressured to invest just because you have cash sitting around. Cash is an option on future opportunities. Sometimes the best investment decision is to do nothing. Fourth, you need to manage your emotions. When everyone around you is panicking, you need to remain calm. When everyone around you is euphoric, you need to remain cautious. This is incredibly difficult because humans are social animals. We're hardwired to follow the herd. Going against the crowd feels dangerous and uncomfortable, but in investing, the crowd is often wrong at extremes. When everyone is terrified, that's often the best time to buy. When everyone is greedy, that's often the best time to be cautious. Being a contrarian isn't about being different for the sake of being different. It's about independent thinking, about doing your own analysis and trusting it even when it conflicts with popular opinion. Fifth, and this is something I feel strongly about, most people should not be picking individual stocks. They should invest in low-cost index funds and hold them. I know that sounds strange coming from someone who's made a career of picking stocks, but it's the truth. Stock picking requires time, interest, and temperament that most people don't have or don't want to develop. There's no shame in that. An index fund gives you a piece of American business at very low cost. If you just hold it and add to it regularly, you'll do better than the vast majority of professional investors. In fact, I've made a bet with hedge funds over this exact proposition, and so far, the index fund is winning handily. The wealth migration I'm describing is going to benefit index fund investors too, because they're not making the behavioral mistakes that active traders make. They're not buying high and selling low. They're not trying to time the market. They're just consistently accumulating shares in American businesses over time. That works beautifully. If you want to pick individual stocks, that's fine, but recognize it's hard work. You're competing against professionals who do this full time. You need an edge. For most people, that edge simply doesn't exist, and they're better off indexing. I've seen this pattern many times. In the late 90s, people were buying internet stocks with no earnings, no profits, sometimes no revenue. Because they thought someone else would pay more tomorrow, it worked until it didn't. When the music stopped, trillions of dollars of wealth evaporated. The same thing happened with housing in the mid-2000s. People bought houses they couldn't afford because they thought prices would keep going up forever. Again, it worked until it didn't. These episodes always end the same way. The late buyers, the people who jumped in near the top, they suffer the most. The early sellers, the people who took their profits while everyone else was still buying, they do fine. This is part of the wealth migration. Wealth flows from late buyers to early sellers during bubbles. What worries me now is that I see speculative behavior in various corners of the market. I see people treating investing like gambling. I see complex financial instruments that most people don't understand. History suggests this doesn't end well, but I also know that trying to predict exactly when it will end is impossible. I've seen bubbles last far longer than I thought possible. The market can remain irrational longer than you can remain solvent, as the saying goes. So the answer isn't to try to time these things precisely. The answer is to avoid participating in obvious speculation and to have capital ready when the inevitable correction occurs. I remember during the depths of the financial crisis, I wrote an op-ed for the New York Times titled, "Buy American I Am." This was in October 2008 when the world looked like it was ending. The financial system was in crisis. Major institutions were collapsing. Fear was everywhere. And I wrote that I was buying American stocks. People thought I was crazy. But I wasn't saying the economy would recover immediately. I was saying that over time, American business would thrive again, and if you bought quality businesses at panic prices, you'd do very well. That's exactly what happened. The people who bought during that period of maximum fear made fortunes. The people who sold during that period, who let fear dictate their actions, they missed one of the great opportunities of their lifetimes. That's going to happen again. I don't know when, I don't know what will trigger it, but there will be another period of maximum fear at some point. Market history is cyclical. We have periods of optimism and periods of pessimism. We have booms and busts. That's never going to change because human psychology doesn't change. When the next period of fear arrives, that's when the wealth migration I'm describing will accelerate. That's when wealth will flow from the fearful to the brave, from the emotional to the rational. The question is, which side will you be on? I also want to talk about the importance of saying no. In investing and in life, success often comes more from what you don't do than what you do. There are thousands of investment opportunities available. You don't need to participate in most of them. In fact, you're better off saying no to almost everything and only saying yes to the few opportunities that are truly exceptional. Most investors can't do this. They have a fear of missing out. They see others making money, and they feel compelled to participate. But you don't have to participate in everything. You can let opportunities pass by. The right opportunities, the ones that fit your criteria, they'll come along eventually. Patience means being willing to say no repeatedly until the right yes comes along. I've passed on countless investments over the years. Some of them worked out, and I missed gains. But many of them didn't work out, and I avoided losses. The key is having a clear set of criteria and sticking to them. Don't adjust your standards just because you're anxious to invest. Don't lower your requirements just because you haven't found anything in a while. Discipline means doing what you said you'd do, even when it's uncomfortable, even when it's boring, even when everyone else is doing something different. Let me also address something about risk. Most people misunderstand what risk really means in investing. They think volatility is risk. They think a stock that bounces around a lot is riskier than a stock that stays stable. But that's not how I think about risk. To me, risk is the probability of permanent loss of capital. It's the chance that you'll invest money and not get it back. A stock can be volatile but not risky if it's priced cheaply relative to its underlying value. Conversely, a stable-looking stock can be extremely risky if its grossly overpriced risk is primarily a function of price. If you pay too much for something, even a great business, you're taking risk. If you pay very little for something, even a mediocre business, your risk is limited. This is why the margin of safety is so important. By only buying when there's a significant discount to intrinsic value, you're building in protection. Even if things go wrong, even if your analysis was somewhat flawed, you've got cushion to protect you. Most investors today have no margin of safety. They're paying full price or more than full price for assets. That means if anything goes wrong, they're going to lose money. During the wealth migration, those investors are going to suffer. The investors who insisted on a margin of safety, who were patient enough to wait for genuine bargains, they're going to prosper. You get to choose which side you're on. That choice is made through your actions today and tomorrow and every day after that. It's made through what you learn, what you read, how you think. It's made through the discipline you exercise, the patience you demonstrate, the rationality you maintain. It's not complicated. It's not about having special information or access. It's about applying timeless principles consistently over long periods of time. It's about doing the simple things that work even when they're not exciting, even when they're not fashionable, even when everyone else is doing something different. So my advice to you is simple. Start learning. Start building your knowledge base. Start thinking about businesses rather than stocks. Start developing the right temperament. Start being patient. The great wealth migration is coming. Position yourself on the right side of it, not through luck or timing, but through preparation, discipline, and sticking to sound principles over long periods of time. If you do that, you'll look back years from now and realize this was one of the most important decisions you ever made.